Hello everyone, good morning. Welcome to today's webinar. I'm your host CA Rahul Bajaj. Today's topic is overview of some of the recent developments and controversies under the Income Tax Act. So we have guest speaker Vasudevan Ji. Vasudevan is qualified chartered accountant as well as lawyer, having graduated from ILS Law College, Pune. He has post-qualification experience more than 6 years. He is currently a tax manager at Globeview Advisors LLP, a boutique consulting firm based out of Pune, focusing on providing tax-centric business advisory services, where he advises clients on transaction structuring, cross-border taxation, and corporate tax issues. Level has experience of advising Indian as well as MNC clients and Indian promoters. Prior to Globeview Advisor, Vasudevan was associated with DMD Associates, a leading law firm. Prior to Globeview Advisors, Vasudevan was associated with DMD Advocates, a leading law firm in India, specializing in tax litigation. At DMD, he has represented various MNCs and large corporates in their direct tax matters before various fora, including High Courts and Supreme Court of India. He also catering to various tax advisory assignments.
First of all, very good morning, everybody. Thanks to Rahul ji for inviting me to speak on this topic. Really glad to be present here and interacting with all of you. At the outset, I would also want to thank you for taking your time out on a Saturday morning when you really want to relax yourself after a long week, and then coming over here to listen to a talk. Rather, I would want it to be a discussion. It's just an opportunity for me, honestly, to take this as a discussion with other professionals, and with this difficult time of pandemic, I think it is a great initiative by Rahul ji to allow all of us to come over here and speak and interact and continue our professional education. The topic that I have to speak today is just to give you overview of some recent developments and controversies under the Income Tax Act. So, of course, it's almost been a year since the last budget, and the next budget is almost underway and is likely to be presented in about next 10 days. And with this, of course, some of these amendments have happened maybe a bit even more than a year ago, but all of them are quite substantial. So I'll take you through some major amendments, and I've picked up a few topics out of these amendments which have some relevance or have been creating a buzz in the recent past. Along with that, I'm also taking up a few controversies that has been happening, in the courts, and they have also been creating some kind of discussion and controversy in the professional forum. So, not that something that all of you are not aware, but I think this is a good forum for us to discuss it further and deliberate on certain things in more detail. So, just to briefly look at some of the very major amendments that has happened in recent past. So some of it are happening are from the budget, and some have happened after as a after effect of the budget. So just to give a very brief background on this is one on the advance ruling part. The budget 2021 substituted the authority for advance ruling with a board for advance ruling. And by virtue of this amendment, a board was constituted in September. And subsequently, very recently, the CPDT has come up with advance ruling scheme. and the e-advance ruling scheme. So the budget provided for a faceless advance ruling mechanism, and this has now been taken into effect by introducing the scheme of e-advance ruling. So this is very, very recent, and we would be deliberating on this a bit more in detail as to the essential feature that has changed by way of this amendment. Then even the CIT appeal as well as ITAT have been proposed to be faceless. CIT appeal has become faceless, whereas ITAT is yet to be completely operational in the faceless mode, because it is operating on a hybrid hearing model, but nevertheless the oral hearing is the norm, and it hardly happens that you don't get a oral hearing at all before the ITAT. And but before the CIT appeal, the faceless appeal scheme has had a certain, rocky road to say, because initially there was a scheme which had uh, a discretionary power on the on the appellate commission or the national level appellate authority, which was a centralized authority which was processing all the appeals, getting all the submission, and passing the order. So it was a centralized process, and the hearing in that case was highly on a discretionary basis. Subsequently, there was PIL in Bombay High Court, and there was also a transfer petition which was filed in the Supreme Court to hear the matter as to what is really if the scheme is appropriate and if the scheme needs to be changed, and whether it is violating any of the fundamental right, especially the natural justice aspect of it, where the hearing itself was not allowed. So after this PIL and the matter in Supreme Court, the government has gone ahead and uh, and changed the scheme, whereas now they have decentralized it to the level that there are various CIT appeal who are appointed. I think Pune has about 10 CIT appeal. Of course, the name etc. has not been disclosed, but there are CIT appeal separately who would be dealing with the cases, who would be taking all the submissions, etc., and would dispose of wherever the SSC wants to make a representation by way of oral hearing. The SSC is absolutely free to do so. And if the SSC requests, then the authority shall allow oral hearing, but that oral hearing has to be on a virtual mode. Right. Apart from this, some recent changes in the tax administration is with respect to statement of financial transaction. So this is I think an extension of 26 AS based reporting or information that we had. So we used to get the information of all the taxes that has been deducted by employer or wherever the TDS specifically has been applied. But now they have broadened the scope of this reporting, and you can now see whatever income that has accrued to you through some financial institutions, etc. And these income or these transaction, then you can separately you can look at this, create or file your objection wherever you feel that the income has been wrongly attributed to you. So that objection would be specifically disposed of, and if there is no objection, then this income definitely would be cross-tallied with the income that you are returning in your ITR, and this match or mismatch would become a basis for department to conduct assessment or even to make additions to your income. So this is a recent change that has happened, because there have been a lot of questions on a department tracking all your moves, but that definitely is changing and becoming the norm now, and department indeed is tracking all your transactions, right? And another very, very important amendment was revamping on the reassessment regime. So the reassessment regime, as it was earlier, has been substantially revamped with new provision, some to the benefit of the SSC and some to the benefit of the department. So we will deal with this amendment more in detail because it has high relevance in our practice. That is number one. And apart from that, there have been a lot of cases that have been going around into this reassessment regime. Which one should apply post first April 2021? There have been some controversy. That's the reason why we would deal with it more in detail further in my presentation. Then the slum sale transaction has now become taxable on fair value basis. So this was the amendment in Finance Act 2021, and they have also expanded the definition of what is slum sale by virtue of what is slum sale. Earlier, the slum sale included only a transaction by way of sale. Now, every transfer which otherwise satisfies the definition of some slum sale would be classified as slum sale. So this mainly happened because of various cases in courts where they said if there is an exchange or you pay the consideration for purchasing the undertaking by way of issuance of shares, where you're not really selling or where the transaction is not happening for cash. In those cases, slum sale provisions did not really apply. So this triggered the amendment to the slum sale taxation provisions, and now every transfer falls within the realm of slum sale if it otherwise satisfies the definition, right? And partnership taxation again has been revamped in Finance Act 2021. So there also a fair value based takeout from the partnership firm on account of dissolution, reconstitution, etc., have now been made taxable. So and apart from that, another change was with respect to equalization levy. So the equalization levy provisions came into being from Finance Act. Of course, there was different equalization levy from 2016. Then on the e-commerce, etc., the equalization levy started from Finance Act 2020, and which was further widened by Finance Act 2021 by including various other aspects into the equalization levy provision. Then there was TDS, which was introduced on purchase of goods itself beyond the limit of 50 lakhs. And then the goodwill taxation happened. So when there's that also has been changed by way of Finance Act 2021. So if there is any merger transaction where some goodwill is generated, then in that case, that goodwill has been considered as non-depreciable, whereas the Supreme Court judgment way back in 2012 or 2013 has allowed depreciation on such goodwill. So the self-acquired goodwill or the goodwill which is acquired for a consideration has a different tax treatment, which continues now. So taxation laws amendment act, which was enacted in 2019, brought into effect the lower tax regime for new companies. And this also, the same act also gave out some provisions for existing company to fall into a lower tax regime, which is at 22%. For new manufacturing entities, which is set up after 1st of October 2019, they are allowed taxation rate of 15%. Of course, subject to a lot of conditions and restrictions on the deductions that they can claim or the benefits under the Act. For example, 10AA deduction is not allowed, ATIA is not allowed. So all of those deductions have been taken away, and rather Chapter 6 deduction, except a few, are not allowed to be taken. So deductions were taken away and the tax rate was lowered, which in a way does simplify the position, the tax computation. So this in a way simplifies the taxation scenario, but for companies who are having existing losses, the amendment did not allow those losses or MAT credit for that matter to be carried forward. So that is the reason a lot of companies are still contemplating if they should forego their MAT credit and brought forward losses if they want to get into this realm of lower tax regime. Right? And similar was allowed for individual and HUF, where the slab rates have now been provided with lower tax rates. So now we all are aware that the slab rate that we have till now is up to 10 lakh rupees, and beyond that, everything is taxable at 30%. But the tax regime which was introduced now allows a slab based taxation up to 15 lakhs, and beyond 15 lakhs, it goes to a 30% rate. However, in practice, if you don't allow any of the deduction, which primarily, all SSCs have been conventionally taking, then for now at least, there are no major takers. I would say very few people who did not have a lot of savings, etc., are taking benefit of this regime. Otherwise, a lot of people who are still having ATC based investments or deduction available to them, then they are really not keen on getting into this regime because that is not beneficial to them at this moment. So this broadly, so there are many more amendments which happened in the recent past, and it has taken almost a year for us to digest all of those amendments, and we already have the next budget happening very soon. So I think we have to then gear up for next amendments that is coming up. But we are not getting into any of the other amendments because I think many days would be required to get into all of these amendments in detail. So we have just picked up just a few amendments, and we have gone into a bit detail more from the practice side, which is on the department related communications and department related activities rather than on substantive law. On the controversies from court side, I've taken two scenarios which I'm discussing in detail. So I'm making it a very pointed discussion rather than picking up something very broad. Apart from that, at the end, after those four aspects, so these in between these four aspects are what I'm going to deal with. The reassessment regime, the authority for advance ruling, the replacement in software taxation. This has also created a lot of controversy. And then reduction on education says this is a very interesting aspect. And then some budget expectation, that I feel to my limited knowledge can really be useful. Of course, there are experts who can make a lot of predictions. So something that I feel could be very important, I've just pointed down just to give my views and open to listen to all of your views. So as we move into the specific aspects, if you have any question, I would prefer we can take it, you can note it down, and we can separately have a question answer session, subject to, of course, Rahulji's approval on whatever is the time available.
Yes,
yes,
definitely.
Yeah, we can take those questions, and I'm ready to discuss.
We request all the participants to note down their comments in chat box, or so that we can address in sequence. Thanks a lot.
Certainly. Right. So, and these are just my views, my thought process. So I'm open to any discussion on that as well. So now looking at the reassessment regime, the reassessment overall has been a very vexed issue where, first of all, a closed assessment once done now creates, takes a new avatar or starts a new innings for the department, and by way of that new innings, the department is empowered to make a lot of additions to your assessment. Now, if you look at the earlier reassessment regime, there were I think umpteen number of cases dealing with various aspects, and to look at to safeguard or to give some more benefits to the SSA, considering this can be harsh on many. The new reassessment regime has been introduced. A new assessment regime was introduced by Finance Act 2021, and it specifically provided that this reassessment regime is applicable from 1st of April 2021, right? And uh, just a second, Rahulji, if you can confirm, I'll just, I think some light issue is there. I'll just switch off this one light, and can you just confirm if that is okay? Otherwise, I think there's some lot of glare on the video.
Okay, no issues. From our side, it's okay.
It is okay. Then I'll continue. Sure. So looking at what are the major changes that has happened in the reassessment regime, because reassessment earlier was on the basis of reason to believe. So there was a reason to believe which was required, or which was a mandatory condition for the department or for the assessing officer to have for reopening the assessment under section 148 or 147. So reason to believe had its own interpretation, and what amounts to reason to believe was again a debatable issue. And this reason to believe earlier, it could be on the basis of information. Of course, any information that comes to the assessing officer's knowledge, either by way of, say, some other SSCs, search and survey cases. So there were various sources from which the AO could get those information, and those information he was required to specifically apply his mind on and do independent analysis of that, and then he could issue reassessment notices. So now this aspect has been changed, which to get away from the subjective satisfaction of the assessing officer to information-based reassessment. So if there is information which is suggesting some income escaping assessment, then the reassessment proceeding can really start. Now, another major change, there is a mandatory prior inquiry and representation which is required before issuing notice under section 148. So a new section 148A was introduced, and there was inquiry which was required to be done to satisfy to the satisfaction of the assessing officer that there is still a case for a reassessment that needs to be done. And the time limits for initiating reassessment has been changed, and now search and survey cases, there used to be separate regime, and that now has been merged into the reassessment regime itself. So just to recapitulate before we deal with these a bit in detail, just to give a recap on what was the old reassessment regime. So there was no procedure per se for giving reasons or disposal of objections or filing objection, etc. This was specifically dealt with by the Supreme Court in the case of GK and Driveshaft. It's a landmark case, and I don't think there's any reassessment which is happening without making a reference to this case. So GK and Driveshaft case really set down the procedure that needs to be followed for doing a reassessment. And under the old regime, as per GK and Driveshaft, the AO was required to issue notice under section 148. As soon as a notice is required, usually the AO would ask you to file a ITR. Then once you file the ITR, the SSC was mandatorily required to file the ITR, and then they can seek the reason. So without filing the ITR, you cannot seek the reason. So if you don't file the ITR, earlier you could simply write a letter to the assessing officer saying, my original return, you consider that as a return which is filed under section 148. So now, after filing the ITR, you could seek the reasons. Once you have got the reasons, you were allowed time to to file objections on that reason, to say that the reasons which have been noted by the assessing officer is not really substantial to create or to have any reassessment subsequently. So this objection could be filed, and the AO has to dispose of these objection by way of a speaking order, and has to deal with all the aspects and say why the submissions of the SSA is not made good, and why the reassessment has to continue. So after that, once the objections have been disposed, then the AO could issue notice under section 143(2), and it's just like an assessment which otherwise happens, and the reassessment order is passed. Right. So let's get into these aspects a bit more in detail, the changes that have happened. Right. So reason to believe, like I mentioned, it has got a evolved jurisprudence. So a lot of cases, it cannot be a borrowed satisfaction. So simply if someone uh, provides you any information, or say or even CAG objection for that matter, there's a CAG objection, you should have to apply your mind separately, and then or do your own investigation or inquiry on that matter, and then you have to say, or you have to initiate the reassessment. That was the position under the old law. Now a reassessment can be initiated, or the proceeding can be initiated, if you have any information. So now I think, to put it simply, uh, the information, it has got its own definition, that either this information has been flagged by risk management strategy formulated by board, or a final objection raised by CAG. Now, when you look at the risk management strategy aspect, it can be anything from the CBDT perspective. So even a senior officer finding some irregularity or some uh, some kind of issue with any SSC, he can always suggest you. That becomes a information. So if it was not a information, uh, so it has to be, just the sources have been limited, but these sources uh, now becomes more undisclosed, for the reason that the risk management strategy could be very, very different. Of course, some readings show that risk management strategy is more of the IT based risk assessment that is done by the CPTT. So this probably could be one of the uh, uh, this can actually, if it is followed in true spirit, can reduce the sources from where various reassessment initially would have started in the old regime. This can definitely reduce all of those aspects. Then the final objection by CAG aspect, CAG does internal audit, or does audit of the assessments, and they raise a lot of queries. So the final objection becomes final objection only when the representation of the department has been heard, and then the CAG feels that there is still, the assessment has not been in accordance with the provision. So after the representation, if the CAG feels, or if CAG takes any particular view on a matter, that also can now create a reason or create an information by way of which the reassessment can definitely begin, right? And going to the mandatory notice part. So now the GK and drive shaft allowed, before any reassessment happens, allowed representation on the reasons to believe, and the objection could have been raised by the SSE to say that all you believe is not really true, or not really substantial, or does not really create any scenario which was not really disclosed to you in the in the assessment position. Now this independent inquiry was required even under the previous law. Now also this independent inquiry is required, but by way of a formal show cause notice now, and this has been now embedded. The principle in GK and drive shaft have now been embedded in the law, and that is happening by way of notice under section 148A, and corresponding inquiry, corresponding objections, etc., hearing as well. And then hearing by the SSC, and then they have to dispose of the objection specifically. If the objections have not been found substantial, then or substantiated, then the reassessment proceedings would begin under Section 148. And the sanctioning procedure was there even under the previous regime. So all the reassessment notices which were issued had to be sanctioned by the superior authority, and those sanctions were very specifically. There are jurisprudence to this effect that the sanction also has to be after application of mind by those authorities. They simply cannot say, okay, I approve or I sanction or go ahead with the reassessment. So it has to be something where the senior authorities also had to apply their mind and then give a sanction for reassessment. So this sanctioning procedure continues, but only the threshold or the authorities who can give permission have changed basis the timelines which is involved, because the timelines now has been based on the quantum of income that might have escaped assessment. So basis that quantum, automatically the sanctioning authority has changed. Now what is the time limit that has changed? So if we make a comparison between old regime and new regime, in the old regime, up to 4 years from the end of the relevant assessment year, the reassessment could have been initiated without any specific reason or any specific grounds. So up to 4 years, this was allowed, and in the new regime, this has been reduced from 4 years to 3 years from the end of the relevant assessment year. So this is a positive change with respect to the SSC. Then under the old regime, there was a special case where income has escaped assessment beyond rupees 1 lakh, and also there are many grounds to this. One of the very major grounds is failure to disclose all facts during assessment. So if there was anything that was not disclosed in the assessment, then the department could open or could initiate reassessment up to 6 years instead of the original timeline of 4 years. So this increase from 4 years to 6 years had to satisfy additional condition. So every time within 6 years if there is a reassessment, then you could have also challenged that any of those grounds which have been made out, which needs to be made out to initiate a reassessment up to 6 years, have not been made out. So that also used to be some of the grounds on which you could attack it. So that was one scenario. Another scenario was if the income which probably has escaped assessment was in relation to foreign assets. In those cases, the reassessment could open up to 16 years. Now these conditions in the new regime has been restricted to 10 years. So what has happened, what could have been done up to 6 years has now been extended to 10 years, but subject to the conditions that the income which has escaped assessment exceeds rupees 50 lakhs. And in addition to that, the AO must have some books of accounts in his possession or other documents or evidence which says that the income chargeable to tax, which is escaped assessment, represented in the form of asset, is exceeding 50 lakhs. So this threshold limit of 50 lakhs, as well as these conditions of AO having the books or documents or evidence, and they reveal that income chargeable to tax has escaped assessment. So it's not a mere suspicion if someone has to read it in a very in a strict sense. It should reveal that there is income which has escaped tax, and those are represented in the form of assets. So in those cases, things have moved to 10 years. But so this in a way increases the limit from 6 to 10 years in favor of the department, but subject to the threshold of 50 lakhs rupees. And there is a specific proviso which says that for assessment beginning prior to assessment year 21-22, because till that time the old regime was in progress. if something could not have been initiated under the old regime, cannot be initiated under the new regime. So since the old regime had a time limit of only 6 years, then in the new regime, it will still be restricted to 6 years. But anything beyond assessment year 21, from assessment year 21-22, would apply a period of 10 years, which is available to the department for initiating the reassessment. So if you see the limitation, if I look at the due date of 31st of March 2022, then under the new regime, you can initiate reassessment only up to assessment year 18, 19, and not prior to that, unless you have you've satisfied the condition in the second leg, which is income escaping assessment beyond 50 lakhs. So subject to the 6-year period. So in that case, it gets restricted to 2015-16. So anything prior to 2015-16, of course, would not have been allowed to the department even under the old regime. But under the new regime, since tenure has been inserted, still the restriction would be up to assessment year 15-16. The department cannot go beyond this. With respect to foreign assets, there is no mention in the new provision, so we don't know what is the current status of this. Right. So due to pandemic, in the old regime as well, there have been a lot of extension. So now this really is a contention for a lot of writ petitions. So what has happened? The old regime due dates have been extended time and again by the department due to the pandemic situation, and you would see I've noted down specifically with respect to 148 notices what otherwise would have ended by 31st March 2020. So which is under the 4 years norm 15-16, under 6 years norm up to assessment year 13-14, and for foreign assets assessment year 3-4, that was extended to first to June 2020, then subsequently to March 2021, and to April 2021, and subsequently to 30th of June 2021. Right, and now as we are aware, the amendment came to effect from 1st of April 2021. So what has happened that the notification which extended the period from 31st March 2021 to 30th of April 2021 contained an explanation that old provisions as before, which were existing before Finance Act 2021 shall continue to apply. Right, and so this basically meant that any reassessment beyond which is initiated after 31st March 2021 can also, which was as a matter of extension from the previous year that has been happening because of COVID, only those reassessment can happen after 31st March 2021 as well, but under the old scheme, wherein directly 148 is issued and then you give objection, etc. All of those procedures are followed. And similarly, when extension happened from 30th of April 2021 to 30th June, similar explanation was contained. So now the question that came, so a lot of SSCs got reassessment notices after 1st of April 2021 under the old regime, where directly 148 was issued. Under the new regime, direct 148 is not allowed. You have to follow the procedure under 148A, and then only you can issue a reassessment notice. Now this created, a wave, rather a sea of writ petition before the courts, which said that the procedural law from 1st of April 2021 should have applied, but you have gone ahead and you have not really applied the procedure, which was in effect from 1st of April 2021. You applied the old procedure, and the contention was that a delegated legislation, which is a notification, cannot override the specific provision which is given under the Income Tax Act under section 148. So this specific, so whether the question was whether a notification can override what has been specifically stated in the law, because section 148 or 149 or any of these new provisions, the new reassessment regime that did not say that subject to any extension that might happen in the previous regime, or even the enabling act, which was uh, taxation law. So this was the enabling act, taxation, other laws, relaxation, amendment of certain provisions Act 2022. This basically allowed extension of timelines, but did not say that you can decide which law should apply in what scenario. So if there is an extension, this is not allowed to make a notification as to the new law would apply or old law would apply. So the contention were that the notification has gone way beyond the scope of the original act itself, and therefore the notification is therefore the explanation which said the old law would apply is invalid. Nobody challenged that the extension cannot happen. So notification is not a problem, but the explanation which said that old law will apply, even though even though the statute is providing that the new law after 1st April 2021 would apply. So this very contradiction needs to be decided and should not be allowed, or should be, should be held as ultra vires, the provision itself, and therefore all the reassessment notice needs to be quashed. So these were the contention, and the matter has been happening in various high courts. So I have listed down six out of this. I listed down six out of this. Five have been decided. In Bombay High Court, the matter is pending. Chhattisgarh High Court has taken a very different view, and it allowed all the reassessment notice to go through, saying that this was a conditional legislation. The the situation demanded this kind of extension, that is appropriate, but nobody there challenged the provisions of the notification. Nobody said the explanation is invalid. So that was not the challenge before Chhattisgarh High Court, to be fair. So since that was not challenged, they simply said that reassessment notices are valid. Whereas all the other high courts that have decided the matter already, they have decided this against the SSC, and they have struck down the explanation which is given in these notification, which is applying the old law for notices issued beyond 1st April 2021. So I think anything not less than 2000 or 2500 in all of these court matters put together, these many number of reassessment notices definitely has been quashed. So in Delhi High Court itself, I think it was more than 1300 writ petitions. So can you imagine the kind of the contradiction that happened now, and it is very likely that the department would look into this provision or this change in the budget, and they would create appropriate amendment in the law so as to enable the department to go ahead with the with the reassessment. So in the Bombay High Court, I think the matter is coming up on 10th of February next month. So that is yet to be seen what is the view in Bombay High Court takes. Yeah. So this was more on the reassessment and the court cases. So these matters are still going on in various other high courts as well, but really all of them might become infructuous if there is an amendment that happens in the Finance Act that is to come. So let's move to the next topic now. So I'll quickly brief you through this, where under the Finance Act, the advance ruling mechanism was changed because there were a lot of matters which were pending in advance ruling authority, and for years rather, and the otherwise allowed timeline is only 6 months. And because there were no judges who were ready to be part of authority for advance ruling, because their ruling were subject to writ petition. So this could be one of the reasons why it was not allowed, or nobody was forthcoming for the appointment. And the appointment nevertheless did not happen, and the matters were going on, and there was huge backlog. So this triggered the setting up of board for advance ruling. So in the Finance Act 2021, the board for advanced ruling provisions were created, where the department said, or where the legislature said that the board for advanced ruling would constitute two officers who are not below the rank of chief commissioner. So these two officers would, inherit all the matters which were pending before the earlier board directly, and all new applications can also be made to this board. So this board would, again, the same time limit of 6 months was allowed to them, and they said they would dispose of the matters. And subsequently, by virtue of this amendment, on 1st of September 2021, three board for advanced ruling were created, two in Delhi, one in Bombay. And now, after this, advanced ruling scheme has been notified. So this has happened just 3 to 4 days before. So this advanced ruling scheme 2022 has now been notified. So I'll just take you through the changes that have happened, and this will basically uh, also highlight what is the features or the important features of the new scheme that has been introduced. The mode of application has changed, that you make the application to advanced ruling by way of an email. So the old matters get transferred as it is, along with the documents, data, etc. When you want to file a new matter, you have to do it through a mail to the secretary of the board for advanced ruling. So the matter is accepted that way. Secretary reviews the files and he can get back to you for making the changes, etc. And then that is the file is put up before the authority for before the advanced ruling board. Then the oral hearing has been changed or revamped, and here you can have a hearing through video conference. In-person appearance is not allowed, but the provisions still say that the video conferencing may be allowed. This has not changed, similar to CIT appeal scheme. So still there is a subjectivity which is involved for allowing hearing on advanced rulings. And the binding nature of the ruling, earlier under the AAR regime, the ruling was absolutely binding on both SSC and revenue. Of course, they were subject to, since there was no appeal before any other authority, the SSC or the department would take it to the High Court in a writ petition. So it was still subject to challenge, but not in the statutory way. It has to be under extraordinary remedies, and you would file a writ petition before High Court, and then the High Court would get into the legality of the order, etc. But nevertheless, for the legally, it was a binding order on both SSC as well as revenue. But now the e-advance ruling specifically says that the matter is subject to appeal. You can always make an appeal before the High Court. So the ruling is now not binding, right? And the appealability, again, which is these both aspects are connected. Appealability was not allowed under the previous regime. Now in the new regime, you can always appeal it before the High Court within 60 days. And this appeal can be by both SSC as well as revenue. I think it could be a conscious call from from the revenue that in any case the matter we're going before High Court. So this can automatically, now they themselves might as well allow the appeal on their part, and they have allowed the revenue as well to go into appeal, which is I think under DRP scheme they did not allow the revenue to go, but now they have allowed here specifically for revenue to appeal. Now, what are the key takeaways? So apart from this, just to briefly say that the other procedure remains very, very similar to what was there before AAR, right? And before AAR, there was procedure to get information from the department, etc. Here in the scheme, they even allow communication with FT and TR division of the CBDT for SSC who are for parties who are not subject to assessment in India. So FT and TR reference could also be made in that case. So for FT and TR is foreign tax and tax research, where the information regarding the non-resident SSC could be obtained from the foreign countries. So that is now allowed. So some key takeaway is that some recent experience show that when the constitution is uh, by department officials, then the reliance on it of the independence, I would say the client does not really prefer to get into the advanced ruling with having some common apprehension, which is possible because it's all internal now to the revenue. So experience under other law also can have similar things to suggest. Right? So that can be one of the challenge to make it more incentivized. So what could have been done probably is that they could have considered appointing a panel, something similar to ITAT, where they are not department personnel, they are individuals who are selected to be the members of the ITAT. They could have done something very similar here for disposal, and they can continue on a permanent basis. So there is no problem otherwise. And timelines, if they are updated, of course they are very good. So the procedure, uh, it can be effective. What is more prominent is that the if you go through WAR route, you get a easy access to High Court by way of this. So within 6 months, the matter is disposed and you can go to High Court. Which otherwise, if you have to go through the appellate route in general, can take many years. 4 to 5 years, very easily. So now you have a very very fast approach to High Court. So even DRP scheme at times, SSC looks at that because within 9 months you get an access to ITAT, so which is quite fast compared to CIT appeal scheme. Similar could be the position here as well, and there is no finality of facts or law. So usually we see under the act when you go through normal appellate route, there is a finality to the fact once the matter is decided by the ITAT. Only the question of law can be challenged. But now this will create a question of fact position before High Court. So there is no guidance on this, which I think is very unlikely because the High Court would not set into a question of fact, determining whether factually things are appropriate. So then the administrative hassle of managing email communication could also be something very challenging. Yeah. So now going to the next issue is the dispute on software taxation. Because this is, I think, one of the very very major landmark decision that has happened and much talked about uh, in the fraternity, and this is on the taxation of raw software, purchase of software as royalty. Now, if you look at the judgment, that's basically involved a lot of Indian SSCs as well as foreign SSCs. So, Indian SSC with respect to their TDS obligation, and foreign SSC with respect to the income that they are earning by way of selling the software. And the question was whether selling software license would amount to royalty, or the consideration for that would amount to royalty under the provisions of the Act along with the DTAA. Right? And if it is so, then whether 195 needs to be done. So this essentially involved foreign parties in it. So the Supreme Court dealt with 4 scenarios where the computer software is supplied by non-resident. In all cases, it's supplied by non-resident, and it is sold directly to Indian resident end user. Then the second is it is sold first to distributor, and that distributor sells it to user. So the distributor in the second case is an Indian party. Third case is there is a foreign distributor who is selling it to either Indian end user or Indian distributor. Or the fourth case is where the software is embedded into a hardware, and that system along with the hardware and software is integrated equipment is sold to the Indian end user or Indian distributors. So these were the 4 broad category that was there before the Supreme Court, and the Supreme Court, held in this case some specific issue and some very general legal position, which was true even otherwise. Something like the beneficial provision of TTAA would override provisions of the Act. This was a fairly settled law, and now they have reiterated this. And Section 195 deduction is mandatory only when a sum is chargeable to tax in India. So this was already the decided matter in GE technology. The case now basically reiterates that and specifically again provides for it. And there was also an argument, very interesting argument that was made by the revenue in this case, is that once your case falls under a taxable scenario as deemed to occur or arise in India under 916, then you must deduct tax. The benefit of DTAA provision will be claimed by the SSC at the time of making their own return. So 195 has to happen if there is a tax under the Indian tax under the Act itself. So this argument was specifically rejected by the court and said you have to apply DTAA provision and then see the taxability, and only if the amount is taxable, then you deduct tax under 195. Otherwise, you don't have to deduct tax under 195. This is one very important finding by the court. Then on the specific aspect of software taxation, the court said that the computer software is a literary work under the Copyright Act, but the provisions of Section 916 so before explanation which was inserted, I'll come to that explanation. So the provisions under 916 read with the DTAA applies only when you get a software, when you pay, when you get the copyright itself in the software, not when you get a right to use the software where the copyright is not transferred to you. So the meat of the finding is this, that when you receive a right to use a copyrighted article and you don't get the copyright itself, then there is no taxability. The amount that is paid cannot be termed as royalty, because royalty under the Act as well as not under the Act. Under the Act, the definition is very, very broad. Under the DTAA specifically, they said that royalty is applicable only when you get the copyright of the product and then you pay consideration of it. So until unless you get the copyright, you don't have the consideration is not royalty just by receiving a copyrighted article. So this was specific, again made a reference to TCS case where they said software is a goods. So software put in a medium is a goods. And it's a copyrighted article. Just because you are getting software and you are using it and you are getting the benefit out of it does not mean that you are getting the copyright itself, because you cannot change anything in the software, you cannot replicate, you cannot do any of those act which is otherwise constituting a copyright. Therefore, you don't get a copyright itself directly. You get a copyrighted article. And payment for a copyrighted article is not a royalty. Payment for copyright is a royalty. So this was the primary finding. And the court goes on to say what amounts to copyright. Then it makes a reference to Copyright Act and says that when you get a right similar to that of an owner, to reproduce, to make a copy, to sell it to others, to allow others to do all of these activities. So when you get all of these rights, then only the case falls into the realm of Copyright Act. Otherwise, it doesn't. So reproduction or copying, they specifically mention you simply copy it in your system, just one copy for your own use, intended use. That does not amount to reproducing or copying. It should mean that you are able to copy the whole thing and you are able to sell it to somebody else. It's only then that you are getting a copyright or you're getting a right to make a copy or right under the copyright. So various aspects that has been considered. In essence, they said any software transaction where you don't get the copyright directly, you are not taxable under 916. Then they specifically note the change in the definition in section 916 by way of Finance Act 2012, where the provision now very specifically states that once you have a copyright, once payment for software, computer software, falls under the definition of 916. So it is it, right to use a property. It falls under that definition, and by virtue of that, any computer software today, if you purchase, if you look at the definition in the act, then it is very broad. It will definitely cover payment for software into the definition of royalty you would have to pay. But if you have a DTAA where the definition of royalty continues to remain narrow, then you definitely have a benefit and you don't have to tax the same in India as royalty. So however, there are a few DTAAs where the software taxation aspect is covered. So some example of that could be Russia or Kazakhstan. So in those cases, the DTW provision itself, covers this software taxation, and therefore it will become taxable. So wherever you have benefit of DTAA, you are saved for now, and wherever not, then the software payment amounts to royalty, right? So another aspect is now if you are getting a software or software like utility over online platforms. So most of it today are online based software. So in that case, now equalization levy might apply and there need not be any. So if you get out of the realm of this software taxation as royalty, you might fall under the equalization levy provision if you are getting it through e-commerce platform. So nevertheless, there is some tax that is happening. But now, of course, there are questions on equalization levy itself with Pillar 1 commitments, where the allocation of tax rates would be different. And other question that might arise is whether access to online software facility would still be royalty. So just to look at barring the equalization levy provision, if you look at the definition, or if you look at the ruling of the court and whether it will apply to online access to software, yes. So it should apply because even when you're getting online access to software, you're not getting any copyright in the system or software. Till the time you're not getting any copyright in the system, you still are covered by the definition of the act and by the ruling of the Supreme Court, and you still would be in a favorable position per se. Right? Other questions is whether because of IT infrastructure like hosting, etc., whether that is supposed, whether that would amount to royalty. So IT infra like web hosting, the Bangalore tribunal has taken a decision that the amount that you pay to Amazon Web Services or similar services, where you are getting some benefit by way of cloud computing, where the software or the activity or the utility is happening online, the definition or the ruling of the Supreme Court would still apply, and you would get the benefit of that, and the payment that you make is not royalty. But interestingly, Pune Tribunal in two cases have seen a different scenario. So I'll just quickly tell you the fact. Here, there was a foreign entity and there were Indian entities. The foreign entity was sourcing different software centrally and was creating, an infrastructure at its own end where it would allow the Indian users, the subsidiary which is in India, the Indian users to have, some basic applications, access to basic applications like client management, finance, etc., etc. And the cost pertaining to that software which was created or centrally located source software was being charged to the Indian entity. The Pune tribunal said that you are creating a IT infrastructure and you are not really allowing, you're not directly allowing the benefit of the software. So it's not just the software, but it's a complete equipment to that effect. So IT infrastructure created by you is an equipment, and in the first case, reader machine, they didn't say anything, but in the Baycard, they go ahead and extend this and say the equipment that you're creating is a industrial royalty under section 914A, and it is not a royalty for software. So because it's a equipment that you have now created by using those software. So it's a next stage. It's not software royalty. It's a case of equipment royalty, and that is not covered by the Supreme Court decision. It's a very interesting, interesting judgment to read. And then they say that if you look at the equipment-based royalty, it requires you to have some access or physical control, etc. There was a change in the domestic law which said you don't need physical access control. It can be located anywhere, but if you're getting an access to the infrastructure, then you are good to go. Then you still will be taxable. But under the DTAA, there is no such expansion of the definition. DTAA still says if you're paying any royalty for use of industrial equipment, etc. The tribunal has applied the expanded definition, which says you don't need physical control, but the tribunal has not, in my respectful submission, has not really gone about and checked what is the interpretation of the DTAA, because DTAA still has a narrow definition. If you apply that benefit, there is no physical control, there is no use directly of that infrastructure, and therefore this should not have been a case of software royalty in my humble submission. But difference could be there as to the interpretation. They have not looked into DTAA provision in this case. On the contrary, the Delhi High Court applies the judgment of Supreme Court in a similar case where in EY Global Services, where there is a centralized sourcing and all the member firms are allowed access to those software which have been centralizedly and which have been sourced centralizedly, and then they say that you are just allowing access to those softwares, just becoming a middleman. You're allowing access to those softwares only. Still, there is no transfer of any copyright. Therefore, there is no implication of royalty in this case as well. Right. So this basically settles a very, very long drawn dispute that has happened on software royalty. I think the matters which are involved in this pertaining to assessment year 2, 3, etc. So it's been going on for long years, and finally the issue was settled in the Supreme Court. So moving to this one small aspect, which is on education cess. So education cess, like all of us are aware, the amount that we pay on our tax, including of surcharge, is at 4%. Yes, tax liability might be a small amount, but the applicability, if you look at it, is pervasive. It applies to everybody. The education cess of 4%, in that sense, is a very, very important aspect. So what has happened is that you pay taxes. The law under PGBP section specifically disallows payment in the nature of rates and tax. So tax levied on PGBP is specifically to be disallowed under section 48(2). Now the question was whether education cess amounts to tax. So then there are different judgments which says in very, very divergent manner. Some are against, some are favorable. So now the question is whether education cess is a tax. The Rajasthan High Court, Bombay High Court, and even Pune Tribunal in this matter, I think persistent system is also one of the matter, where they have gone ahead and said education cess is not a tax. Therefore, education cess that you have already paid can be claimed as a deduction in your income tax return. They have relied on this circular of 1967, where it stated a comparison between the provision under 1922 Act and 1961 Act. 1922 Act disallowed cess as well in addition to rates and tax. But in the 1961 Act, the cess part was removed. So the court said that the Rajasthan High Court said that the legislature never intended to bring cess into the realm of this disallowance. Therefore, there's no disallowance that is required. and education does not form part of tax. Whereas there are other views which covers education cess. Specifically now the Kolkata High Court as a Kolkata Tribunal is a very direct judgment which disallows specifically education cess, and it relies on Supreme Court judgment which says income tax includes surcharge and additional surcharge. Right. So the Supreme Court judgment held this way, and subsequent Supreme Court judgment, which is very recent, that also says surcharge on sales tax. So this was a surcharge under different act, but it says that also falls under the definition of tax. This the subsequent Supreme Court judgment also relies on K. Srinivasan case, which was way back in 1972, which says income tax includes surcharge and additional surcharge. Now the question comes whether education cess is a surcharge. The Finance Act 2004 and 2011 says education cess is introduced as additional surcharge. Now, since education cess is an additional surcharge, by looking at the definition in the Supreme Court judgment in K. Srinivasan, it should become tax essentially, by implication, if not directly. Now, if this becomes a tax, then the disallowance happens automatically. Now, the question really remains that the courts have not gone ahead and interpreted the nature of cess, whether it amounts to tax or not, rather than getting into what is the wording that is used by the legislature. The Kolkata Tribunal actually differentiate or divert, or rather say that I would take a differing view as compared to coordinate bench, because Kolkata Tribunal itself has allowed education cess in various other cases. They then say we want to dissent, saying the court orders did not take notice of Finance Act 2004 and 2011. Actually, this might not be completely appropriate, because in the Rajasthan High Court judgment in Chambal Fertilizers, the 2004 introduction in the Finance Act was definitely mentioned to the court, and then it took a conscious view of saying that cess is not part of income tax. So whether you can take a benefit of this or not is something that is interesting. And for a lot of SSCs, if the benefit can be taken, and this would help them in a way, because education cess is paid by everybody. But with respect to MAT credit, the position is that the MAT credit is allowed on tax differential in the year in which MAT was paid to tax differential in the year in which you are falling under the normal tax regime. So this comparison happens at a total level, including surcharge and cess. So whether now for MAT purpose you want to include cess in tax, and for other purpose you want to exclude cess, so this becomes a debatable issue or contradiction that you take. So this again is for to be thought through, and there can be some clarification in the budget as well to this effect. So with this, so these were my thoughts on some specific aspect. Now, some budget related expectation. So it's just expectation of a common man who wants some benefit out of this budget, specifically with respect to COVID. So these are just my thought process. There can be very differing views, and a lot of views are taking rounds in the media, and it can be very different. But something that I feel is that individual who are having taxable income up to 7.5. So now you have benefit up to 5 lakh with respect to rebate, etc. But honestly, with the COVID situation, there has been a lot of spend on medical treatment, if not medical treatment, just medicines, etc. And there have been a lot of spending that has been happening. So there has been a temporary tax rebate up to 7.5 lakh rather than 5 lakh, just a number which I think could be reasonable. So that you don't really get into taxing people having good salary income or good income overall, so to say. And what I expect is that COVID related measures, so all of these measures would be more temporary, because the government would not want to do any major change for something as temporary as COVID. So this is something which is possible. Then the ATD limits can change because the insurance policy rates did change last year by a large sum. That is one aspect. Then a change in overall deduction for it, medical expenses, so medical treatment under Section 80 DDB. Right now, the section read with the corresponding rule includes some really big diseases overall, so to say, like thalassemia, etc., AIDS. So, but COVID at least temporarily can be included in this, and any medical treatment that has happened can form as a deduction for the SSC, right? And when it comes to a lot of industries have underperformed or severely been affected by COVID, there has to be corresponding relief, or even taking over of these industry or industry consolidation should provide some tax benefit there. And then yeah, so a lot of entities have spent a lot of money on COVID relief, so everything is voluntary and strictly looked from the taxation perspective. uh, the donation, etc., if you make, that's not tax deductible, so that at least for COVID purposes should be allowed as a tax deductible expense, because a lot of companies have been doing it on their own. Even if they had profits, they didn't have profits, they still were doing a lot of tax benefits, so that should be allowed. Then ATC threshold has been there for some time at 1,50,000, so I think that calls for some increase with passing of time. And even in the lower tax regime has not been having a lot of takers, honestly. So side has lower tax, but not really. It rather leads in higher tax position. So that maybe some rationalization there and some deduction should be allowed for the taxpayers. And then ESOP tax. So for startups, the ESOP tax, on exercise of shares was deferred by some period. If sale happens early or other, at least a 2-year deferment was allowed in the previous budget. So right now also a lot of companies are not having a lot of cash, but they might be paying ESOP quite possibly just to retain talents from moving away. In that case, you should consider, or the uh, government should consider it, extending it to everybody. It's fair, honestly, when you get consideration for sale, you pay tax on it, rather than paying tax when you don't really receive any money at all. That's quite harsh on any employee for that matter. So that needs for some rationalization. And tax disparity, of course, between company and LLP. So there is one side you are saying that I want to reduce corporate tax rates, but you are reducing, the government is reducing, no doubt, is trying to do it in a phased manner, but the other entities continues to remain taxable at the same rate. Partnership tax at 30% only. So there's no change that is happening for other entities, which is a disincentive, basically. So that should not be the case. One should be allowed to, carry out their business in whatever way they want. But that is essential, and I think that should be allowed now. So crypto related changes is also expected with the way crypto is creating a buzz in the market in general. The cryptocurrency, whether it should be currency or whether it should be capital asset, and whether now if it's a capital asset, then what is the taxability, and whether there should be TDS provision just to keep track of the transaction, etc. All of these that need, probably, I think this has a very good chance of being featured here. Separate crypto law might not really pass in this budget as we read in the news, but at least the taxation related provision, because transactions are happening, but taxation related provisions can definitely come into picture. And so, like we mentioned, reassessment related changes possible because of the court decision. So broadly, these sum up my thoughts on what could be the possible amendments that can arrive. There can be many, and there's no end to our wishes, and it can go on and on. So these are my thoughts. So I'm happy and willing to discuss anything further on any of these aspects, any questions that you all have. So we'll take you through and happy to discuss.
I first of all thank you for value adding in everyone's life. Today's session was very interesting and up to the point, very detailed one. So now I open window for everyone.